Wake up, world. This isn't just another political headline. It's a full-blown global economic warning. When the International Monetary Fund, known for its calm, calculated, and typically restrained tone, breaks character to issue a stark warning about political instability threatening the global financial system, it's a clear signal that something is dangerously off track. The IMF now warns Donald Trump's return to power and his unpredictable, self-serving, America First economic agenda could wipe out a staggering $1 trillion from global output. This isn't just hypothetical. It's a very real risk. Such a blow would amount to nearly a third of the impact seen during the 2008 global financial crisis. But this time, the world is even more vulnerable. We're not just dealing with economic missteps, but with a political powder keg that sits at the heart of the global monetary system, the United States. Trump's trade policies, wrapped in nationalistic bravado and economic saber-rattling, have raised America's effective tariff rate to its highest point in over a century. These abrupt and inflammatory decisions, marketed under slogans like Liberation Day, are causing ripple effects across an already strained global financial landscape. The IMF's Global Financial Stability Report doesn't mince words. It reveals how Trump-era unpredictability has contributed to a dangerously overvalued U.S. market, especially in tech stocks and government debt. Hedge funds have made massive speculative bets that are now unraveling. As a result, they're being forced to sell off U.S. Treasury bonds to generate cash, a move that risks sparking further turmoil in the already fragile bond markets. Even more alarming is the IMF's comparison to the March 2020 COVID-era dash for cash, a market panic that nearly collapsed the U.S. Treasury market until the Federal Reserve intervened. This time, however, developing nations are especially exposed. They are already facing the highest real borrowing costs in over a decade. Trump's tariffs could force these countries to take on even more expensive debt just to survive the economic aftershocks, raising the specter of a dreaded sudden stop in capital flows, a brutal halt in the money lifeline they depend on. And where is this shockwave emanating from? The very nation meant to anchor global stability, the United States. A little over a week ago, historian Adam Tooze from Columbia University speculated that markets may have started to sell America after a dramatic plunge in the prices of long-term U.S. bonds. His assessment? This wasn't just a reaction to economic data, but to systemic political risk. In particular, Trump's relentless tariff threats and his increasing public pressure on Federal Reserve Chair Jerome Powell are now being seen as potential triggers for widespread market fear. Tooze gave us the theoretical framework. The IMF just supplied the hard data. Over the weekend, Trump intensified his attacks on Powell, deepening market unease. The response? Capital fled U.S. equities, bonds, and even the dollar itself, assets historically viewed as global safe havens. Investors rushed instead to gold and other shelters from uncertainty. Some market losses have been temporarily clawed back, but the underlying concern remains. This isn't just inflation anxiety or growth pessimism. It's fear of political chaos, of the rules being rewritten in real time, of the institutions meant to guarantee economic stability being weaponized for partisan aims. This perhaps explains the seemingly contradictory messaging from the IMF. On one hand, its report lays out a blunt and unvarnished warning. On the other, senior officials speak in soothing tones, clearly trying not to ignite a panic. This is central bank diplomacy at its finest, signaling deep concern without triggering the very crisis it's trying to prevent. But make no mistake, the real problem isn't just technical glitches in bond markets or temporary Fed policy missteps. The true crisis lies in the politicization of economic management, what economists call the monetary fiscal nexus, under a Trumpian regime that has demonstrated hostility to the norms and institutions of liberal democracy. When even the U.S. dollar, once the unshakable pillar of global finance, begins to lose its reputation as a safe haven, we're not just in trouble, we're in uncharted territory. What comes next? If the dollar fails, if markets lose faith in America's economic leadership, then where can the world turn? And here's where journalism plays a critical role. The Guardian, in a powerful editorial follow-up, reminds readers why their voice matters now more than ever. As Trump gears up for a possible second term, this time surrounded not by resistance, but by growing compliance, The risk isn't just economic, it's democratic. Already, U.S. media organizations have begun to bow under pressure. Billionaire owners are pulling election endorsements, reporters are being drawn into Trump's orbit, and even major networks like ABC News have opted to settle legal battles in his favor, to the tune of $16 million. But not all media are backing down. The Guardian stands firm, declaring no interest in becoming Trump's friend or any politicians. Their only allegiance is to the public. With no billionaire backers, no shareholders demanding profits, and ownership by the Scott Trust, The Guardian remains committed to truth-telling and public accountability. Their mission is not to appease the powerful, but to inform the people, and they do so without paywalls or hidden agendas. In a world where power is increasingly wielded without restraint, and where even the global economy trembles at the whims of one man's politics, independent journalism may be one of the last lines of defense. The IMF has issued its warning. The Guardian has raised its voice. The question now is, are we listening?